Hello and welcome to another video as part of the technical analysis series. Today we're talking about timeframes. Here's the outline for today's lesson. We're going to start with a disclaimer, move on to some general remarks. The first real topic will be managing expectations, where we'll go over some guiding principles and broadly discuss how to treat different timeframes differently. We'll then move on to timeframe selection. This very popular topic, but very misunderstood, in my opinion, so try to shed some clarity there. We'll then move on to trend, precedence, and market structure, so your basic directional bias type of stuff, and there'll be some reading to do before we get into that section. Then, of course, you couldn't have a cred YouTube video without the bit where we draw on the chart, so we'll talk about refining and contextualizing levels. And we'll round off with some trade-specific topics, entry triggers and trade management being the examples in this case, and then conclude. Disclaimer, usual stuff, please pause it and familiarize yourselves, but I'm not a financial advisor. This is not legal or financial or investment advice of any sort. This is for entertainment purposes only. If you're not happy with that, please leave the video now, and trading is risky, and please, if you're going to engage in it, do so at your own risk. So some general remarks to set the scene. Multi-timeframe analysis, which is essentially analyzing a market while relying on more than one time frame to do so, is essential when building a coherent and actionable view of a market, as we'll hopefully discover as we go through the presentation. Right. Now, the importance of multi-time frame analysis, you probably came across it already at some point in your early trading, when you were reading all these trading maxims and principles and, checklists, guideline rules, whatever, that always used to say smart-sounding things that, like, trade with the trend and, trading against no one ever got broke, trading with the trend, and all these kind of nice-sounding fluffy phrases, but without much substance or guidance as to what those things actually mean, right? Especially bearing in mind, surprise, surprise, that one instrument can have more than one trend at any given time, depending on what time frame you look at, and what tools you use to ascertain a trend. Given that, it's no surprise that these utterances are kind of useless on their own. Okay? So we're trying to add some nuance, add some substance, and actually elaborate upon them to make them actionable. Now, this is an important multi-time frame analysis is an important skill for traders of all styles and time frame preferences. Even if you're a low time frame trader, I think it's important to have an understanding of what the dominant trend is, where the high time frame levels are, what price is coming off of, in terms of, what did it hit before reaching your level. I only see positives, right? Absolute worst case, if you do your diligent, replicable, rigorous multi-time frame analysis, is that you don't rely on it, or you don't need to rely on it. Okay, fine. But best case, or as you'll hopefully see, there is no kind of downside to it, and it's purely positives in terms of informing your view of the market. And as you've seen in the outline, we'll also cover trade management, entry triggers, target selection to some extent, and what I'm trying to get at is multi-time frame analysis positively affects all the different stages of a trade, right? It doesn't suddenly become irrelevant when you've, say, opened a position. I think it's something that's ubiquitous. Now, you'll see at the bottom there's some recommended reading. It's not really recommended. I'd say it's more mandatory to get the most of this video. I'm not in the business of reteaching my own content. That would be redundant. So there are things in this video that I borrow, rely on, and assume you know from the article. So this would be an excellent time, and I implore you to do so if you haven't already, to pause the video and go read the article, make some notes, familiarize yourselves, at least have it open, and then you will have a much better time understanding the content that we're going to go through now. Managing expectations. Very vague and useless header, if I'm being honest, but to add some substance, what I'm essentially getting at is when it comes to managing expectations with regard to timeframes, we're trying to answer the question, what can be reasonably expected from price at a level on a given time frame? And the at a level is arguably in brackets as well, right? It's just from price on a given time frame is fine as well, but obviously sometimes levels are involved also. So 3 basic principles that are worth being aware of as we go through this presentation. Number 1 is that high time frame trends are longer, or perhaps last longer, and are harder to reverse, right? So if you've got a weekly bullish trend, which means that week after week after week, price is making higher highs and higher lows. If that's happening for weeks on end, that's going to be a long trend. And also, it's going to be harder to reverse because you've got a high time frame dominant trend. Okay, clearly there's some strength in the instrument if week after week it's making higher highs and higher lows. Now, an example to kind of put this in the context of a mental chart, if you will, is this point here. Okay, so if we split it into 2, let's say price breaks market structure, makes a higher high on the hourly, so that information on its own. Okay, that's A. And then the context in a weekly downtrend, B. So on its own, you might think, and correctly and reasonably, that price making higher highs, uptrend, breaking out, whatever, on the hourly time frame is in itself, taken in isolation, a bullish development. And you'd be, again, in a good position to think so. However, if that statement, if A is then qualified by B, that the context of this higher high, this breakout, this uptrend, on an intraday basis, is a higher time frame downtrend, then suddenly this isn't so bullish anymore, right? So on its own, A would be something like this, okay? And you'd think, oh great, this looks strong. Let me just redraw it a bit, something like this. Yeah, okay. That's your hourly uptrend. You think, okay, this is technically bullish and breakout strength and so on. However, when then we get the qualifier or the context that it's a weekly downtrend, and suddenly, if you get something like this is the direction of the weekly trend, right? And then suddenly you've got this little hourly higher high, it's not so bullish now, is it? And you would reasonably expect for this to be a small kind of correction or retracement before the dominant higher time frame trend takes over again. So do you see how the same information, right, the same piece of information, this higher high hourly breakout, which is bullish, when it is qualified or put in the appropriate context, it can completely change your view of the instrument, right? Which is completely fine, which is exactly why we like higher time frames, because they give us more evidence and they contextualize intraday moves. Okay? So, high time frame trends are longer and harder to reverse. Principle 1. Now, point 2 is that bigger moves are more likely to originate. You've seen I've been very lazy here and missed the actual verb in the sentence, which is terrible practice. But bigger moves more likely to originate from high time frame levels, or intraday levels formed at or within high time frame levels. But it's still obviously the high time frame levels that are in charge. Okay, and then in terms of the relevant examples, we've covered this section here. Price reaching weekly support. Okay, so weekly level of support as opposed to support on the 15-minute time frame, and that we're going to assume is only visible on the 15-minute time frame. Now, just on its own, reading that, you should have quite different expectations from price, which is what we're talking about, right? So let's take a Forex example. Like, I haven't got the stats at hand for this, or at all, but let's say price reaches a very nice weekly level of support that's going to get bought. Is it reasonable to, let's say, expect a 70-80 pip range or move away from weekly support? Well, yeah, on the weekly time frame, a 50-70 pip move isn't some, fairy tale reaction of a weekly level. High time frame levels, we expect moves that are going to be visible on those high time frames should the level do its job. And by definition, those are going to be big moves, right? It's a whole week, for example, like a green candle of price going up. So let's say 50, 70 pips for a weekly support level doing its job, quite reasonable. Okay, that shouldn't raise any eyebrows. However, let's say you've got a 15-minute time frame level in isolation. That then looks completely different. If price hits this level that on the higher time frames would look like it's in the middle of nowhere, and then you get a 50, 70 pip rally, that's slightly different. So hopefully you can see what I mean by reasonably expected. Is it reasonable to expect a 50, 70 pip rally from weekly support, let's say in the first half of the week or something? Yeah, that's fine. You wouldn't raise an eyebrow at that. However, if you have a 15-minute level of support that doesn't have any confluence or line up with anything else, price hits it and rallies 50, 70 pips straight away, that's slightly less reasonably expected than the prior example, right? It's kind of tailoring your expectations, like how much work is this level going to do? Or if this level is going to do its job, what can I reasonably expect, or what can I reasonably expect for the chart to look like? Okay, hopefully that makes some sense. And the third example is that price can take more time to resolve at high time frame levels. Okay, so the example here is price consolidating at hourly support for 12 hours versus price consolidating at weekly support for 12 hours. Now this is always kind of a hilarious I guess the level of dissonance that tends to form when price action reflects this is hilarious. So let's say you've got an hourly level of resistance. Okay, and then price comes into it. And then let's say you get a reaction that closes at the top. Then you get closes below the level and then runs away. And this is on the hourly time frame, so this takes like a couple of hours, not even a full trading session. No one would have any problems with that, right? Hourly resistance, price spends 2 or 3 candles there, so 2 or 3 of the time frame periods, if you will, at the level, and then it does its job. Absolutely fine, no questions asked. All done within trading session. Let's take the same structure. So you've got resistance. Price trades up to it. Again, you get a close, let's say at the level. Then you get a close below. And then price runs away. Still the same. However, the time frame is the weekly time frame. You'll notice that when this kind of stuff happens and price only takes a few hours for the level to do its job, or a few periods on that time frame, or a couple of candles, put most crudely, to do its job, no one has any issues with that because it doesn't feel like it's taking long. However, if you get something like this, price spending a week, 2 weeks at the level before it does its job, even though it's a weekly structure, people start shitting themselves before the first week even closes, right? So you get people being like, oh, price is consolidating at resistance. That's so bullish. It's spent so long up here. Well, it's allowed to spend more time up here because it's a weekly structure. So it shouldn't be totally surprising that it might take, lo and behold, a couple of weeks, a couple of weekly candles to resolve. In this case, you are absolutely fine with an hourly structure taking a couple of hourly candles to resolve. So why is it suddenly not okay for a weekly structure to take a couple of weekly candles to resolve? Obviously, the question is rhetorical. This is absolute, the weekly example is just as valid as the hourly example. But because it doesn't satisfy our kind of short-term urges and the short-term desire to be proven correct, suddenly everyone starts panicking here while this is fine. Now, hopefully this third point makes a lot more sense. Price can take more time, or perhaps is allowed to take more time to resolve at high time frame levels. Don't let this is something that should be measured in relative terms, or terms relative to the time frame, as opposed to in absolute terms, which is how many hours has price spent at the level. Anything more than 12 hours, that means the level's not going to do its job. Well, if you're dealing with weekly and monthly resistance, that's not even close to being one full candlestick. So what's the rush? Okay, hopefully that's clear. So these are our principles and a couple of examples to go with them, hopefully. Each of these will get their own kind of section in the video, as you'll see now, after we do the time frame selection portion. So by no means feel that if you haven't understood it now that it's over for you. Right. Time frame selection, very interesting topic. I'm sure in different trading resources that you've come across, you're essentially handed like a toolkit depending on your time frame of preference on how to engage the market. Like, if you're a scalper, you should only use the 5-minute M15. And then if you're a swing trader, you use these time frames. If you're this style, you use those time frames, and kind of matching and pairing a trading style with a certain time frame. Now that's broadly reasonable, but it usually gets taken too far, right? And it's certainly not a reason to ignore other time frames. Like, let's say even if you are a very short-term trader dealing in and out on the 5 and 15-minute time frames, that doesn't mean that there's no good reason or that you should somehow be avoiding the daily and the weekly time frames, right? That they'll still be useful for directional bias. They'll still be useful for giving you certain levels that might not be visible on your time frame, but are still equally significant, right? Basically, the time frames that you prefer to map or engage in with your market are not, it doesn't mean you have to throw the baby out with the bathwater. Okay? Now, obviously, there has to be some kind of relationship between your style of trading and the time frames that you employ, right? You're not going to make a very good scalper if you only use the weekly time frame, for example. Okay? But the issue that I have observed is people simply take it too far. They'll say, okay, well, I'm a low time frame trader, I'm a scalper, so anything that's higher than the 15-minute chart, I'm not going to look at. And what ends up happening is, they're dealing with their... Ooh, gosh, I'm jumping ahead a lot today, my apologies. What will end up happening a lot, let's say you've got the, low time frame, and you're getting like a breakout, and you're like, okay, well, that's a terrible example. Right, you've got a level, and then the range is broken. Right, I'm going to buy with a stop here, and the chart, it doesn't give any information or any important structure up here. It looks like your trouble area is here, but then what they missed is that there is a massive old weekly level right above where they're just buying, okay? And what you'll get a lot of the time is they'll essentially get tunnel vision, or those kind of tank visor focus on their time frame and say, right, market structure's bullish, just had a breakout, I'm long, this is the next 15 level, or the M15 level that I've got, and instead price comes up, gets completely smacked down by this imaginary force that's not on their chart, and they lose money and probably say something like risk is managed, on to the next one, retweet to join my paid group, whatever. Whereas the reality is, this was totally avoidable if they had a good map that included higher time frame levels. This may sound really stupid, but just because you don't have something marked on your chart doesn't mean it no longer exists, right? And I think that's the issue that I see most frequently with newer traders who start with lower time frames. They never really get into the multi-time frame analysis process and end up with these situations a lot of the time where their positions were looking superb, and then this imaginary, yet completely unforeseeable force knocks out their position completely, and they act shocked that everything looked so good, not realizing that it's simply higher time frame levels doing their jobs. Okay, so not drawing a level doesn't mean it suddenly stops working or stops existing, which is why even as a low time frame trader, you should always know where your high time frame levels are at to avoid these sorts of circumstances. Okay? Now, you don't really need to choose a time frame or even a set of time frames per se. If we look at some of the different things that we use time frames for in the bullet point list, you see ascertaining trend or deriving directional bias, delineating levels, so drawing the actual things on the chart, engaging the market with entry, or managing your entry triggers, managing the trade itself. Like, all of these are different constituent parts of a trade, and at the same time they don't have to be uniform with regard to timeframes. So you don't need to say, for example, right, these are the parts of the trade that I think are important or that I'm going to work on, and my time frame of choice is going to be the hourly. Okay, so I get my bias from the hourly, I get my levels from the hourly, I get my entry triggers from the... that's just not how it works. Okay, at the very least, it doesn't have to work that way. And I think if you're doing any type of multi-time frame analysis, it can't work that way. And I think it's a needless inhibition on yourself and your analytical framework if you think in such narrow terms. Okay? Further explanation to follow. Now, trend precedence market structure. As I alluded to earlier in the general remarks section, traders are constantly encouraged with reference to this kind of monolith thing called trend to behave and act in accordance with it in, all sorts of certain ways. Trade with the trend, do not fade with the trend, risk less on counter trend entries, and all this kind of, again, the same trading maxims and wisdoms, but they're not very helpful in themselves, right? Because if you don't have a framework for A, ascertaining what the dominant trend is, or B, a framework that tells you the different trades that exist on an instrument at a given time, and there's always more than one trend on any asset. If you don't have those tools at your disposal, then those useless phrases aren't going to do anything for you, right? So the classic example, you've got a strong up day in the context of a larger downtrend that may have offered a low time frame uptrend, right? So you've got, the high time frame trend is down, you get a small up day, and then continuation in the direction of the dominant trend, right? So dominant trend being down, this is the correction or retracement, and then the dominant trend takes over again. Now, let's say you're on the low time frames, this little bump in itself, if you get your entry triggers early, could be enough for a trade in itself, right? At the same time, if you're a swing trader and you haven't got a system that tells you what the dominant trend is and how to behave around it, or how to interpret this price action in the context of this dominant trend, then, how are you supposed to engage the markets at all? Right? So that's what I mean by more than one trend at any time. Yes, the dominant trend may be down in this example, but on this day, the trend was up. So if you don't have a system that tells you how to deal with that, or how to interpret those moves, or how to navigate through the fact that there is more than one trend present on any instrument at any given time, you're going to struggle. And that's what we're trying to cover to some extent today as well. Okay? So instead of focusing on cool sounding phrases, I think the better question is, and you can essentially split this into two as well, right? So part one, what is a dominant trend and how is it ascertained? Or hint for my framework, market structure, right? But again, pause the video again and go read the Directional Bias article, because it talks about this to death, which is why I'm not giving it all the time in the world. So the better question, which can be split into two questions, what is a dominant trend? Okay? And then having established that, what intraday conditions would allow for positioning in tandem with the either trend, dominant trend, whatever. Depends on your time frames and rules of engagement. Okay? So this is what really matters. How do you ascertain which direction is in charge? And then if you've ascertained that, or your system has given you such a signal, how do you then interpret the subsequent price action? Okay? So if you're the kind of person whose trading rules say stuff like, do not fade the trend, trade with the trend, and it kind of starts and stops there, those aren't actionable or useful rules. You need more than that. I think this is a good starting point, right? So, general principles. The dominant trend, and again, this isn't like a super technical term, it just means that the trend that's in charge, quite clearly, I think is most reliably derived from high time frame charts, so your monthlies, your weeklies, and your dailies. Okay? Now, if a dominant trend is present on a high time frame, then it stands to reason that persuasive signs of reversal must also form on high time frames. Right? You see this all the time in markets, especially markets where participants are prone to one side more than the other. I mean, crypto is an excellent example, but it's not the only one, right? Where you've got a market that's trending, dominant trend is down on the higher time frame, and then you get a little intraday spike like that, which granted, this move here, let's say this is the weekly time frame, it may look on the intraday time frame like a super strong breakout, big bullish engulfing candle and so on, to get people really excited. But, an intraday retracement, a high time frame trend reversal does not make. And this is really something to get, this is how you stay on the right side of the market. Being able to interpret retracements and corrective moves as just that, and not hunting trend reversal unless you have good reasons for doing so. Like, quite simply, persuasive signs of reversal must also form on high time frames. If a market's been trending down for weeks and weeks and weeks and weeks, right, you've got a weekly dominant trend in place, purely logically or conceptually, I suppose intellectually, does it make sense to try to call the reversal of a multi-week, so we can assume something's been going on for months, a multi-week trend, by looking at hourly or 4-hour or just any sort of intraday candles? Like, that in itself should offend your intellect, right? And rightly so. And that's how you actually blow up a trading account. Is using very weak evidence to try to time the reversal of very strong trends. Okay, and this is just a classic example, not buying every green hourly candle in the weekly downtrend. Because if the high time frame is dominant or in charge, then these low time frame moves are going to essentially get stamped out and rolled over. Okay? And you don't want to be on the wrong side of that. Certainly not consistently. So if we're looking, if we've identified a dominant trend on a certain time frame, presume trend continuation until proven otherwise. And the proven otherwise must also form on the high time frame. Right? You're not going to be that type of hero who's going to call the top of a weekly trend with an hourly candle. Or at least I don't think that is a particularly judicious way of allocating one's capital or trading generally. And it's just very unlikely. Okay? So that's the first principle. Well, the first and second, I suppose these go kind of in tandem with one another. This one is very self-evident, but high time frame trends last longer than low time frame trends. Right, so if you've got something that's been trending, like an instrument that's been trending up for weeks, for example, and you haven't been watching the whole trend, and you kind of pop in on a daily candle, and you just see it kind of, the market's gone up a lot, and you think, oh, fucking hell, well, that's bullish, and then the market kind of pulls back a bit, and you're like, okay, well, that was the top, I'm bearish now, and, it's over, and then you're suddenly very surprised when you get trend continuation. It's very similar to the second point, but if it's been going up for weeks and weeks and weeks and weeks, it's going to last a while, right? So it's completely random and unimportant, the fact that you've only caught on to the fact that it's been trending up for weeks quite late, right? If there's a dominant trend, it's probably going to be dominant for a while, right? It's just one of those things that's so, I'm even struggling to articulate it properly, because it's so brain dead. But these trends, you've got a weekly uptrend. That means it's going up for weeks and weeks and weeks, which probably means going up for months. One down day isn't going to reverse that. Nor is it indicative that playing the short side of the move is any smarter than trying to just buy a dip and get long. Okay? So don't be surprised if, you see a pullback, and then it goes up the next day. It pulls back and goes up the next day. And you think, wow, it's been doing that for 3, 4, 5 days in a row. This price action's crazy. Well, no, it's a weekly dominant trend. This is completely normal behavior, right? That's kind of what I'm alluding to in this instant. That was very poorly explained, but it's one of those things that's so obvious but kind of hard to explain to people, that these things can last a while. I think people naturally, maybe it's oscillator mentality, where they think like, okay, well, RSI is like oversold now, or overbought now, so it has to go down. Maybe it's related to that. I suppose just like momentum oscillators, a trend can keep going, much like the oscillator can stay overbought or oversold for a long time as well, right? So that's the other point. We've covered this. We've covered this. Now, the last point kind of puts these things together, is that low time frame, let me just get rid of this for now. Low time frame moves against the dominant trend are counter trend trading or perhaps fading opportunities until proven otherwise. Right? Now, what does that mean? Again, using our example in this little corner, we've got a dominant trend down, and we get a retracement or corrective move higher. You essentially get to interpret this price action You know what? Let's make it slightly neater. Got dominant trend down. You get a retracement opportunity, and this is where you kind of start looking at the market, right? You essentially have two ways to interpret this price action here. One is you're going to be an idiot and think, right, that's it. Market's gone up a little. This is the, it's been going down for weeks and weeks and weeks and weeks. Very clear dominant trend, but this time it's different. This is the reversal, and it's a very, intelligent thing to do to presume that the full trend is reversed just because we're putting in a bit of, a few green candles. That's the first option, to assume trend reversal and to interpret any rally in a dominant downtrend as an early sign of trend reversal. That's option one. Option two is to be reasonable and say, until proven otherwise, so until this higher time frame really starts, turning up, I'm going to presume that this is a retracement or a corrective move before going lower. Okay? And that's kind of what I'm alluding to in this third point. So low time frame moves against dominant trend are counter trend trading or fading opportunities until proven otherwise. So when you see something like this leg, price going a clear dominant trend and price going against it, right, against the dominant trend, it's an opportunity to fade it, as in to step in against it, anticipating trend continuation. Now, sometimes you'll be wrong. Okay, sometimes, indeed, it will be the case that this was the bottom, and from then on price reverses, okay, and you ended up selling, and you lose a trade. But trust me, it's much better to, once you actually have a framework, trade with the trend, and presume trend continuation until proven otherwise, and win trades and win and win and win until you take a loser and you're invalidated. That is a much better strategy than the opposite, which is assuming, because, if you get a dominant trend, right, or like let's say strong trending conditions, you'll get loads of this stuff, right? Markets don't really move in straight lines, okay? So if you're being clever about things and seeing these moves against the dominant trend as fading opportunities, then roughly you've made money here, you've made money here, you've made money here, and then let's say it reverses at this point, you're down, and you've actually lost some money in this instance. That's absolutely fine. Because by staying true to this principle and not fading the trend blindly or trying to be a hero that catches a reversal, you've made money and caught the meat of the move. Taking this one loser is absolutely fine. It doesn't matter because it's been, you've got more winners in the bank. And also, if you've got a really good framework, then you'll know before price goes completely mental that, hey, it looks like the conditions are changing and I should probably start getting long this market. Or at least I'm going to stop shorting it, stop assuming trend continuation, and wait for a clearer picture. Okay? So, in terms of our technicals, our directional bias, and so on, and again, this sort of stuff is covered ad nauseam in the article. If your high time frames are bearish, broken support is likely to turn to resistance. Okay? In which case we like to sell rallies. And the opposite is true, where if your high time frames are bullish, or there's a bullish dominant trend, broken resistance is likely to turn to support, and we like to buy dips. Now, the reason I put the asterisks here is there are other kind of technical structures or technical setups that have become higher probability in the presence of a dominant trend. I think broadly defined, if you're high time frame bearish, you expect resistance to do its job and for support to fail. Right? If you're bearish, you expect resistance to do its job and support to fail. And if you're bullish, you generally expect support to do its job and resistance to fail. Now, how exactly those two things manifest themselves, I mean, this isn't the end of the world, right? You might not want to sell rallies, but instead, let's say your sell setups involve chasing momentum to the downside. Okay? So the directional bias tells you which direction to position, but buying dips and selling rallies is just one way to get on board the dominant trend. But you can just as equally say, I don't like fading, I like chasing momentum. So if I've got bearish high time frame and I see a breakdown, I'm going to chase it. And if I've got bullish high time frame and I see a breakout, I'm going to chase it. That's absolutely fine as well. This is kind of optional and just the easiest way to memorize these things. Okay, there are different setups you can get depending on the trend or on your high time frame environment. I suppose another example would be if my high time frame is bullish, I'm going to see runs on old lows as kind of SFP, stop run, liquidity grabs, whatever, as opposed to genuine breakdowns, right? So the way you interpret the same price action, so let's say, you've got sport puts in a couple lows, runs away, you've got a little, liquidity pool here of sorts, and then price comes down and spikes it, okay? And then this is where you start paying attention to the market once it's below equal lows. The context dictates how you interpret this price action here. If your high time frame is bearish, if your high time frame view is bearish, then you see this breakdown as a break in market structure and a break of support. And you think, right, price has made a lower low, it's probably going to go lower and I'm going to chase momentum. Okay? However, if your high time frame is bullish, then you're saying, right, this is actually liquidity grab and I'm anticipating continuation now that these guys have been knocked out. So do you see, we've kind of gone all the way back to the first point we made, I think from one of the earlier sections, that you can have the same price behavior, but depending on the context, it can mean completely opposite things. Okay, hopefully that's clear. So having done that, refining and contextualizing levels, quite a big one. And it's a very practical topic as well, because there's this common stumbling point that traders get, especially after learning some sort of technique to map markets, be it trend lines, levels, whatever it may be, is that they've got levels absolutely everywhere. They've got boxes, there's a demand zone every $10, a supply zone every $5, the whole chart is a mess. And trading level to level, or from, entry to trouble area, whatever it may be, literally becomes impossible because the whole chart is just one big order block, right? So what do we mean by refining levels? I think there's a really easy 3-step process that you can use, which sounds kind of almost insulting to your intelligence, but it really works well, and something I still use to this day. So the 3 steps, where you first delineate a high time frame level, and this bit's important, at least visually, and I think it helps a lot of beginners in my experience. You use a thick line in a different color, right? This is to get you in the idea that this is a high time frame zone and kind of area where you should be paying attention. Okay? That's step 1. Step 2, and this is kind of where it gets optional already, but you should look for or find low time frame levels in reasonable proximity to the zone, right? So you've got we'll go over this in a second in the chart, but you've got your high time frame line in one color, and then you drop down to your intraday time frames and look for levels or structures that are reasonably close. And again, this is down to your judgment, but it tends to be quite obvious to the zone that you've pointed out. Okay, and then having done that, step 3 is you can elect to either keep the refined low time frame level that you got from your high time frame zone. You can keep only the high time frame level, so essentially stop at 1, or you can make a zone, a box, draw a little cluster, and so on. The important point to note is that this exercise acts as a guide or a filter. Okay, so it's a really helpful one if you've got a chart that's just completely plastered with levels, being like, right, I'm gonna start fresh and go from the high time frames and follow this process, and there's a good chance you'll end up with a much cleaner and actually tradable chart in that case. And generally there's less room for error if your analytical process starts from the high time frames and gradually moves to the low time frames if or when required. Like as mentioned at the beginning, the absolute worst case if you do this top-down analysis or multi-time frame framework is that your high time frame levels don't feature in your trade or your analysis. There's nothing wrong with that. Okay, so just as an example of this kind of 3-step process, let's just take this example here. You've got the highest close, right, before a strong bearish candle, and price is starting to retrace, and you think, right, this is my high time frame zone. I'm gonna look for intraday or lower time frame levels around it. So you can even label it. I mean, TradingView is really good for this. Let's say high time frame zone. Okay, we know that comes from the daily, and then we're gonna drop down to our lower time frames, like our 4-hour, You might think, okay, well, I normally trade on the hourly, for example, and you go back to your zone, and this why this why I suggest that you make the line thick, because it kind of takes away from the precision that people tend to be obsessed about, and essentially leads your eye to the correct area, which is roughly here. Okay? So being consistent with our logic, let's say I like using lowest candle close for support, highest candle close for resistance. I know this is my high time frame area at 12 nines. Well, then I'm going to pick my levels tool again and make the level red and thinner, and then look for the highest intraday close in the same zone as the high time frame level. So let's say this highest close here. Okay? And then you get an excellent level, because again, price will be somewhere here at this point as we're doing this analysis, because we know that we've got, again, using highest close as my level logic, that this level comes from a daily highest close resistance. It's given me a zone to work with, roughly this cluster of, or this head and shoulders-y area here, and I'm looking for the same, or just any type of structural level, just simply on the lower time frames. Oh look, I can use the highest close structure again. This is the highest close before the sell-off that broke these lows or broke market structure. And then we are left with the choices that I outlined in the beginning. You can either keep the high time frame level, keep just the low time frame level. You could make a bit of a box of it, right? Saying H1 plus D1 resistance and kind of just draw it like that. Whatever you want, right? But there's a good chance that if you're plastering levels like here, 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 and just across this whole consolidation, you then have a much more actionable area or level or structure, whatever, to deal with, right? And you can see even though we're dealing with high time frame zones, even if you were to take the box approach, it's quite a tightly defined area you come about, or you get as a result, right? That's kind of what I mean procedurally. I'm not going to give you a million examples. This is one of the things I'd rather you do with self-study, but it works really well. Okay, so this time we're refining levels. It's essentially making less of a dog's dinner of your chart and refining them to be in proximity to the high time frame zones that matter. And we know that's important because, as we discussed in our managing expectations section, the high time frame levels are the ones from which we expect a big reaction, and we want a big, violent, trend-forming trades, if you will. Okay? So the intraday level that we delineated on the Bitcoin chart, we know that it's got a bit more oomph and punch behind it because it's in confluence with a higher time frame structure. Okay? So it's both a filter, but also a kind of probability enhancer of sorts. So that's refining levels. Contextualizing levels, probably one of my favorite things to talk about and integrate into my analysis, right? Let me just make sure I haven't missed anything. Oh yeah, I guess the last bullet point present on that slide is, for me personally, if there's no daily time frame logic present in the setup, either in terms of directional bias, read the damn article, or structure, I'm not involved, right? This is something a conclusion I arrived at probably about 4 or 5 months ago, after just getting my ass handed to me on trading purely intraday timeframes and doing what I was telling people not to do in this video, just starting with the intraday and using just that and ignoring the kind of daily side of things. I had enough of losing trades, and so my process now is very high time frame oriented, and at the very least, if there's no daily logic or kind of daily premise for the setup, I'm not involved. That works for me. You don't necessarily have to do that, but as mentioned, I think there are only benefits to having at least an understanding of what the high time frame charts are saying, even if your mode of engagement is the lower time frames. So, contextualizing levels. In the preceding section, we talked about how it's not a great idea to fade a dominant trend every single time you get a chance to do so. So if you've got a strong dominant downtrend and you're selling or you're buying every little bounce, expecting it to be the bottom, you're probably going to blow up your trading account. Right? At least it's a very effective means of doing so. Now, a similar logic can be applied to levels themselves. Right? Just as it's unwise to fade a dominant trend at every opportunity, it is equally unwise, or at least also unwise, to fade a move coming from high time frame structure with nearby low time frame structure. Okay? And the kind of reasoning for, if that doesn't make any sense immediately, that's fine, because that's what the bullet points are for. But if we're to go through it, you'll know from the preceding sections that if high time frame levels do their job, the moves that follow are significant and visible on the high time frame chart. So they're big, right? However you choose to measure that, pip value, percentage increase, dollar size of the move if you're trading Bitcoin perps, whatever. These moves are big if high time frame levels do their job. Okay? That's premise one. Premise two, so if a high time frame structure is going to do its job, then a nearby low time frame structure is unlikely to hold or reverse price. That seems reasonable to me. Okay, that doesn't mean there will be zero instances, in which case price comes into a high time frame level, bounces a little, and shits from the first resistance, high time frame or not. That does happen, but it's not a reasonable expectation for price to do that. The more reasonable and the more probable expectation, and the one with the better expectancy over time, is quite simply that a high time frame level that does its job is going to steamroll a low time frame level that's nearby, right? Because let's say we're getting a minimum of, let's say, 50, 70 pips from weekly support. Weekly resistance 10 pips away is probably not going to do much, right? And the example used here, let's say price reaches and reacts to weekly and daily support, so big area, fading Freddy, smacks it down with M15 resistance 5 ticks away, his ass is done. Okay, his ass is done. And again, I hate to kind of appeal to these non-trading principles, but purely thinking about it conceptually, does it make sense that if this, you're getting involved in a really key high time frame area, the types of areas that completely reverse strong high time frame trends and, send price completely, does it make sense that if you're getting involved at those levels or price reach those levels, does it seem reasonable just, even if you knew zero about trading and just as information presented here, does it seem like a smart thing to do to try to fade that like immediately? Probably not, right? And that's all I'm getting at here. This stuff has to make sense. And if you've got a really strong, confluent, high time frame area of support, surely it's just offensive to your intellect to contemplate swatting that down with some invisible on those high time frames intraday resistance level that doesn't even give any breathing room to price, right? That's pretty much sat on top. So low time frame resistance that's sat on top of high time frame support. Are you comfortable fading a move off a confluent high time frame support with a invisible low time frame level that's sat on top of it? Like, all of your instincts, trading or not, should scream no. And that's all I'm getting at here. But people still do it all the fucking time. Excuse my French. Especially because they have shitty systems for drawing levels, so they'll just like draw lines on the chart and say it's support, not distinguishing between like weekly, daily, intraday, strong, weak, whatever. People do this all the bloody time. They'll just have lines on the chart and say this is support. Okay, I'm going to ignore the fact that it's weekly, daily, confluent, mega level. I'm just going to call it support. And where's my next level? Oh, $20 away. This is my, I've got it labeled as resistance. Well, what that means is I'm going to buy this support and, sell my long at that resistance. Seems reasonable, not realizing that the context renders that a terrible idea. It seems attractive if you were to tell them, would you buy this support and sell at this resistance? Is this a good trade? Purely structurally. They'd say, yeah, sure, of course it is. Level to level. But if you were to call those circumstances what they are and say, would you fade a move off of a high time frame support structure with a invisible or far less significant intraday structure that's very close to that price, you would of course be offended at the question and say no, right? So context is important, and in order to have an understanding of context, something, we don't have a slide on this, but I think it's in the levels video, you need to have a good system for labeling your levels. Weekly levels should be treated differently from daily levels, it should be treated differently from intraday levels. And hopefully the reasons for doing so at this point are becoming clear, because we have different expectations from those structures. And given we have different expectations from those structures, we hold them to different standards in terms of what we would need to see to fade them or to get in front of them with something else. So how does context help? Well, you get to set better targets for one. If you're not fading Freddy and you're actually buying this weekly and daily support and it goes your way and starts to give you evidence and demonstrate that it's going to do its job, if you've contextualized the level and you understand the bigger picture, then you're not going to sell your long into fading Freddy when price has barely traveled away from your entry, right? You'll have a higher time frame understanding that, hey, if I'm right here and this weekly and daily whatever high time frame level is going to do its job, I can expect a move that's worthy, if you will, of a high time frame chart. So therefore my target selection is going to be, let's say, further away. Like I'm buying a weekly level, my target is reasonably going to be another weekly level, right? Again, going back to the whole idea of your intellect being offended, right? As dramatic as it may sound, surely there's something conceptually wrong, or at least that makes you cautious if you were to tell yourself, right, I'm buying this weekly level of support and I'm going to cover it at this hourly level of resistance. Like, doesn't that seem contradictory? And it should, right? Because if the weekly level of support is going to do its job, even haphazardly, it should have no problem steamrolling its way through this, on that weekly time frame, non-existent intraday resistance level. Okay? So set better targets based on context. That's one benefit. And this isn't exhaustive, this is just the stuff that comes to mind. How else does context help? Well, as we covered with fading Freddy, you get to avoid low probability fades. And the question is, you can ask yourself, these are all questions you can kind of ask yourself, is, should I be stepping in front of, in this example, weekly support with M15 resistance? Obviously the answer in this case is no, right? But broadly the framework is, should I be stepping in front of, X with Y? And then you define X and Y and see if it makes any bloody sense. So should I be stepping in front of a move off of weekly resistance with hourly support? Probably not. However, should I be stepping in front of a hourly rally or like an hourly retracement in a bearish dominant trend with a daily resistance level? Well, in that case, yes, right? Now the levels, if you're being clumsy with it, all just look like lines on your chart. And what makes the huge difference, what essentially decides whether this makes any sense, is the context, right? Which is what I'm trying to drive home here. But the lines on the charts themselves are simply not enough. You need the context. You need the time frames. So yeah, you avoid low probability fades. You essentially ask yourself, does this make sense? Is this likely to work out in my favor? Am I being a fading Freddy, not realizing where price is coming from and what a reasonable expectation for a movement off of such a level or from such a level would be? Okay? And then further refines level selection. I guess fading Freddy is useful here as well, but you're basically asking, is this level likely to do anything given the nearby structure, right? Let's see, you've got a huge daily support here, and you've got a big daily resistance here, and then you've got a little M15 resistance here. Like, is this even worth having on your chart if you're buying this daily level with a target at this daily level? I mean, probably not. We could make a nuanced argument that, yeah, you should still have this M15 level to kind of compound, to use it for a flip if price starts going my way, or to manage the trade if it starts moving away, sure. But broadly speaking, you can use these high time frame levels and the context around them to filter out a lot of this fluffy, shitty, low time frame structures that are going to get completely steamrolled if you're anywhere close to right. Okay? Like, if you're buying this daily level and you're correct, like, most likely, if this is A and this is B, everything else is going to get steamrolled and either be used for a flip if you're lucky or just get straight blasted. So why have it on your chart if the context informs you that it's unlikely to do much? Okay, that's what I mean by further refines level selection. Brings your focus to what's probable, what's important, and what's, given the context, is actually likely to offer you a reaction or a trade or a way to manage the trade or something, right? Now, for me personally, again, for those of you who care, I determine the first trouble area, or the first trouble area is determined from the time frame of the setup and entry structure, unless there's a daily or high time frame bias, in which case I'll ascertain the trouble area based on the daily as well. So what that means is if the setup and the logic and all of that stuff is formed on the hourly, okay, that means my first trouble area, my target, will also be formed on the hourly. However, if I identify the trade on the hourly and then look at the daily and I've got a bullish directional bias or like a high time frame dominant trend, whatever, I'll then skip this, expecting it not to hold, and pick a daily target instead. Which is literally exactly what I just covered here, right? The context, the daily bullish directional bias, informs me that this hourly resistance that I would normally sell is much less likely to hold, and if I'm right, it's probably going to get steamrolled. Which is why I then opt, despite the lower time frame logic and entry, for the higher time frame target, because the context is telling me, hey, you would normally be covering here, but there's good reasons to be bullish, so give it some space. Okay, and again, for stuff like how to manage and ascertain first trouble area in the presence of like a bullish directional bias or directional bias generally, please read the goddamn article, because it's really good and a lot of work went into that. Okay, so that's refining and contextualizing levels done. Refining first, contextualizing second. Entry triggers. Now these last two sections, when it comes to the actual, I suppose, trading side of things, they are quite subjective, and you'll need to do a lot of personal research, I suppose, the term to use, and just gather your statistics and the normal due diligence trading process to make sense of these. But I still think we can derive some general principles that are going to be helpful. Recommended viewing my video on entry triggers as part of the technical analysis series. Please watch it, because if you don't, this won't make sense or won't be as useful. Entry triggers tend to be very personal or subjective or varied, whatever adjective you want to use. You can get market entries at candle closes, blind limits, wait for a reaction to the level. You can scale in based on rotations and all that fun PDF stuff, or alternatively go in with one hit in one order. And there's no kind of right or wrong. It just depends on you, your system, how you trade, the tools you employ, your risk appetite and risk management, all of that fun stuff. But some things that I think work well, some things that have worked well for me, still work well for me, and kind of are based on observations from myself and other traders, is that high time frame levels require more patience or can be given more time, right? And that's kind of my thought experiment. Is kind of what we went over earlier. You've got the hourly level and the weekly level, right? Price spending 2 or 3 hourly candles and then dropping is fine. But for some reason, price spending 2 or 3 weekly candles and then dropping, everyone starts having a heart attack by candle 2. That's just, there's no reason for it. It's just pure emotionality. We can see examples of it as well, right? People always hold high time frame levels to unreasonably kind of unreasonable standards. So let's take Bitcoin dollar, right? We had this big weekly level, or this big weekly flip level at like 87.30s. Okay. You can see it was pushed up the top of the cluster, resistance, broke out, failed, resistance again, breaks above it. It's a bit of a pivot, right? And came back and acted as support. Now, when price first came into it, I remember watching, sentiment, crypto Twitter, whatever you want, when this range was formed, and everyone was going fucking mental, saying, oh man, this is so bearish, we've hit a weekly level, it's such a big level, but all price has done is consolidate. And, that's so terrible. It's such a sign of weakness. Price consolidating at support is, it's the end of the world and so on. And then eventually got caught off guard once the move actually came. Right? And you can see the levels still being used at the moment. So you see this stuff all the time, that weekly levels are held to the same standards they would hold like an hourly or an intraday level. And it's just not reasonable, which is kind of the point that I'm getting at with both those examples. The examples I draw on the actual slides, the chart example, is that these high time frame levels require more patience, right? I guess the same thing is with the resistance level that we tested. Last low pre-break, however you want to delineate it, right? If you look at it on the daily time frame, again, you might think, okay, price tested the level once, twice, 3 times, it's consolidating 4 times, no lower low, it's rounding off, oh, it looks so bullish, and then eventually the level chooses to do its job just a bit later and shit. Whereas on the weekly, you can see it trade into the level, and then pretty much the next week already gave you the reaction. It's just 2 candles, but if you're holding a weekly structure to slightly less reasonable daily standards for a reaction, of course you're going to generate false signals all the bloody time. You need to give, judge the level on its own kind of merits and on its own time frame. Just because just because you're impatient yourself doesn't mean that the level has to act any quicker, right? So that's the first point, that they require more patience or can be given more time. And if you rush the matter, you will generate false signals until the end of bloody time. Okay? Point 2 is that there is no need to be entirely uniform in time frame selection, especially with regard to entries. Right? And again, it comes back to that whole point where you don't need to be rigid, saying, I'm going to trade the hourly, manage the hourly, do everything on the hourly, and all my levels and buys are going to come from the hourly. There's no need to do that. And this is especially true with regard to entries. And a lot of good traders, Trade SZ and a bunch of others, will use price action entries of sorts. So wait for low time frame evidence of strength or weakness at high time frame levels before getting involved. So there's no need to kind of tie your own hands in that regard. Now the third point's really important, and it brings together the points that we've talked about so far, is that low time frame closes at high time frame levels are not particularly reliable. You could end up selling the bottom or buying the top. Okay? And as mentioned, moments ago, low time frame assessment of high time frame levels will generate false signals. And more importantly, or perhaps the bigger crime, is that it also assumes that price must turn precisely at the level, otherwise it's broken. Or the level's failed, which is completely wrong, right? So even if we have, say, a weekly level of support, right? And if you were to see this on the weekly, like something like this, you know what? Let's just draw the candle. Here we go. Price comes into the level, forms a bit of a reversal candle, whatever, with a longer tail, and then closes above, ultimately, and then runs away. If you were to see this on the weekly, you'd be absolutely fine with it. Right? No, this is a terrible example of the candle. Whatever. It doesn't really matter. What I'm interested in is the lower portion of it. Yeah, no, this is fine. This is fine. If it closed, if it overthrew the level and closed below it a bit, but ultimately closed above. I mean, I could draw a slightly better example. You know what? Just for the sake of clarity, bear with me here. You can see we're dealing with some very sophisticated technology. Here we go. That's better. Then you get the wick below, level closes above, and eventually runs away. If you were to see this on the weekly, and price obviously came into it. If you were to see this structure in the weekly time frame, you'd be absolutely fine with it, right? Price trades to the level, hits it, reacts, and runs away. Now, what you have to realize is, at this point here, during the low of the week, you had some sort of close. Maybe it was even a daily close or 4-hour close, whatever, below the level itself, right? Because at some point, price traded below the lower boundary of the structure. So that was either an hourly, 2-hour, 4-hour, whatever. On some sort of lower time frame, price closed below the level. Does that mean the level is broken? Of course not. It's just a wick. Or the overthrow, or, price doesn't react to the dollar and completely, ping off these levels like it's scripted. That's not how markets work. Markets will poke, prod, overthrow, do all sorts of things before giving you concrete evidence of direction. Now, if you're someone who was performing a low time frame assessment of high time frame levels, you would be looking at this low before the candle closed, obviously, when price was trading down here before closing higher, and you'd be thinking, right, this is my weekly support, we've had an hourly close below weekly support, it's over, I'm going to flip short on this level, not realizing that you were selling what was the actual formation of the wick, right? Does that make sense? That what may look like, or looks like in hindsight, a very clear reaction to a level, at some point, given that markets aren't perfect and won't just ping off to the very cent, if you use low time frames aggressively to try to ascertain when high time frame structures are broken, you will have a very bad time. And we can look at some other examples on the daily, for example. Yeah, this is an excellent example. If we delineate the same weekly level here, last low pre-break, whatever, this old range low support that got traded back into, and you're watching the rally, and you're thinking, right, this is a major, 9.5, 9.6 is a huge weekly level. I'm going to wait for it to break. And then you see this, and you're like, right, the level's not broken yet, that's fine. And then price trades back into it, and then closes above on the 4 hour, and you're like, okay, great. Well, price, resistance, 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 but now price is closed above the level, and this is a 4 hour chart, so I'm being very conservative. Price is closed above the level, that's bullish. The level's clearly broken, and I'm going to get long. You're committing that same mistake of low time frame assessment of high time frame levels, right? That's essentially what you're doing here. You've got a weekly level, but you're trying to ascertain whether it's broken or not using intraday time frames, and that's what will generate false signals. Closes above, next candle closes right below, closes above again, and then, what happened next is quite obvious. Came back and tagged the level, traded lower. So you just simply can't, right? We'll cover this more in the trade management section, but this is just something to be acutely aware of. That if you try to front run high time frame levels too much using low time frame closes, you're going to have a rough time. That's all I'm saying. Trade management, again, subjective and anecdotal, and the real answer will come from your trading journal. So your data, your stat collection about managing a trade, when you manage it, what portions of a trade management and the effects they had on the final outcomes over enough trades, and all of that kind of stuff. That's for another video. But broadly, trade management principles and timeframes, and what's worked well for me and what I've observed. So beginners have a tendency to be impatient at levels, especially when dealing with high timeframes, right? The idea of selling weekly resistance and maybe having to wait 2 weeks for the trade to play out, that just seems completely unfathomable and abnormal to a lot of newer traders, despite for reasons that we've again covered ad nauseam. Waiting for 2 weeks at weekly resistance is completely reasonable, but it may not sound like it if you just started off trading. And beginners have a tendency, especially beginners, have a tendency to be impatient at levels and look for excuses to manage a trade. Now, the whole idea of wanting to manage a trade is either to just be involved in the market in some way and feel like you're doing something, or just to kind of take the risk off, quote unquote, or make it a free trade, let it run, all that stuff. Those people follow me a bit more closely know I'm far from being in love with the break-even stop, but this isn't the topic for this video. Just broadly speaking, there's a tendency for impatience for a variety of reasons, right? Now, invalidation will most persuasively occur on the time frame that the trade is derived from, right? And this kind of goes back again to this false signals that we were talking about in the previous slide. But just another example, if you're buying a daily level and seeing an hourly close below it, it's not a persuasive invalidation, right? Now, if you're jumpy and you've risked too much on the trade and you know you shouldn't be on the trade, then yeah, that will seem like a big signal. Like if you're staring at the chart all day, you've bought a daily level, and you've seen an hourly close below it, you know, your P&L that you've got blown up on your screen, 200% zoom, goes red, and it closes below, and maybe even the next candle starts trading a bit lower as well, and whatever, looks scary. Yeah, if you're over leveraged, or you've got too much risk on, or just purely inexperienced, that's going to seem like a huge deal that your daily level's seen an hourly close below. But for reasons mentioned in this slide and the preceding one, that in itself is not persuasive in validation. And you'll notice that if you manage, if you don't give your high time frame ideas enough time to play out, or at least give you good evidence of invalidation, what will, simply as a rule, what will happen is you will just cut good trades too early, and not give your own ideas a chance to come to fruition. Okay, and as I mentioned, being hands-off, especially in the early portions of a high time frame premise trade, is a skill in itself. One that I recommend curating sooner rather than later if you're a developing trader, which is why I actually often recommend that newer traders, you know, once they've at least put in some chart hours, put in some screen time with the intraday time frames, actually focus on only trading. You know, observing the lower time frames is fine, but only trading the daily chart for, let's say, a quarter or a significant period of time, just to get into the habit of waiting for setups to play out, having trust in their own setups, and, you know, being patient with management. But yes, when it comes to management and time frames, there's a tendency to be impatient. When you're looking at invalidation, you need to give your own ideas a chance and not try to rush signals based on intraday timeframes when dealing with high timeframe levels. And by extension, being hands-off is a skill in itself, right? Now, in terms of actual trade management, like how do I manage the damn thing once I'm involved and I've not fallen into these early pitfalls? What's worked well for me, and I think is logically, you know, it's a good approach to have to your positions, is to try to manage, especially when you're starting out. Again, there are a million nuances and different ways of doing things when you're more proficient, but managing a trade on the same time frame that it is derived from, or as close as possible. That stops you from falling into that same trap of managing trades on time frames that you have no business managing them on, right? So your daily trades on the M15, that sort of stuff. So what do I mean by that? Well, again, hourly setup and, you know, hourly logic. Maybe the reasonable management timeframes are the 30-minute and hourly timeframe. So ones that are essentially close to the original setup itself. So perhaps not on the 5-minute. So sticking close to the original time frame means you don't, again, fall victim to the same errors of using completely inappropriate time frames for trade management, and it also means that you actually give your ideas a chance to play out on the time frame that they're derived from, which is always a good thing, right? Like, honestly, if you're buying a daily level and you're in there managing the trade 30 minutes later, how much of a chance have you given your idea to play out? None, right? Whereas if you're more bound by the time frame of the trade itself, then perhaps you won't be as jumpy. And this is kind of the macro point that I've been reiterating in 10 different forms in the past 2 slides, that you must assess levels on their own terms and timeframes where possible, or at least stay close. So if you're dealing with daily levels, maybe you want to deal with daily closes and 12-hour candle closes, right? If you're dealing with 4-hour levels, maybe 4-hour closes and hourly closes and so on and so forth. You want to keep it reasonably tight to minimize the frequency of false signals and jumpy trade management, which will mess you up in the long run. And again, do not assume that a high time frame level has failed based on low time frame closes. This is how you sabotage trading high time frame levels, as the conceptual examples have shown us and the actual chart examples on Bitcoin themselves have shown us. And I'm sure your own trading journals and your own personal experience is very indicative of this fact as well. Okay? To conclude what's become a very long video, understandably because that should have covered timeframes in each respective educational lesson as opposed to a big kind of macro video, but here we are. Context is king, and context is more important than structure itself. As hopefully you've understood throughout the course of this video and all the different examples we had and the context and the modifiers, qualifiers, all that fun stuff, the same level can be a terrible fade or a great fade depending on the wider or broader circumstances. Okay, so it's clearly not the structure itself or at least it's not always the structure itself that makes for a persuasive trade setup. The broader context and the story of price, I think, to use a Mr. TA term, is much more important. Or at least it's as important if you want to be taking or framing high probability setups. And that's what the second point is about. Building a multi-time frame picture of the market is superior to drawing levels and punting. This allows you to form your biases and expectations, and actually have a view of the market, as opposed to saying, well, this is a level, if it goes above it, it's bullish, if it goes below it, it's bearish. Right? And trading that kind of, those types of options is very difficult as well, and not very realistic. Like, if trading were that easy that you could draw a level and say I'm bullish above it, bearish below it, and just get your entries all the time and not have to have a bias and so on and so forth, you'd be losing a lot of, no one would ever lose any money if it were that simple. Unfortunately, it isn't. And this is where the multi-time frame analysis and building expectations and biases and so on comes into play. Okay? And you avoid that complacency. At the very least, even if you disagree with me that, this whole multi-time frame picture, context, nuance, Renaissance art, intellectualism, bollocks, even if you disagree with all of that, at the very least, being able to perform multi-time frame analysis will make your drawing levels and punting better. So do it, if not just for that, right? And here's a quick checklist, not one that I strictly follow myself, but just to kind of tie in all these concepts together. Things to ask yourself so you don't miss any complete howlers. What is the dominant trend, if any? Have I mapped my high time frame and low time frame levels? Usually it's the high time frame ones that people miss. The low time frame ones are always kind of easy, right? If you're charting on the M15, it's the daily and weekly levels that you're going to miss, not the M15 levels that you're going to miss. Am I aware what type of level of structure price is coming from, right? For example, if I've got bids at an M15 level, am I comfortable having those bids in place if I know that price has just been rejected by weekly resistance about only $50 higher, right? So again, the context informs the quality and likelihood of success when it comes to the setup itself, even before price gets to the actual level, right? And again, given the above, is my fade or continuation entry reasonable? Am I being a fading Freddy or not? If it is reasonable and all the context lines up with the dominant trend, what price is coming from, what it's coming into, reasonable expectations, all that fun time frame stuff, what are my entry criteria or parameters for engagement? And these are your triggers and all this other fun stuff that we talked about, and the time frames on which the position is entered into, and subsequently you've identified the dominant trend, you've got the levels, you've checked out the context and it makes sense, you're involved in the market, position's open, and then the question of how do I now manage the position. Okay? As mentioned, there is endless room for further study, especially with regards to gathering stats and data on your own trading, but also just how you use this information. At the very least, I'm going to sound like a broken record, but there's no better place to start this further study or to get a more kind of cohesive picture of this topic or of directional bias than by reading my article on directional bias. Just go do it, especially having been through the video now. It will make a lot more sense. Finally, very quickly, normally you'd see a donation kind of Bitcoin wallet address here. Not in this case. My good friend and colleague Donald and I, Technical Roundup is our newsletter. I'm not going to give you a long shill. Go check out the website, technicalroundup.com. Long story short, weekly digital newsletter. Usually ends up being about 30 odd pages a week of high time frame analysis, Bitcoin, altcoin majors, delivered to your inbox. It's like $30 a month, and you get 4 30+ page issues. It's a bit of a steal if you ask me. If you don't, if it sounds like potentially your cup of tea, there's a full preview available on the website. Just go on technicalroundup.com, click the preview button, and read it. And if you subscribe, you don't have to worry about, having to wait until Tuesday, our publication day, to receive the newsletter, because new subscribers receive the most recent issue immediately upon subscribing. And as corny as it sounds, in our long analysis sections, a lot of the stuff that we battle with is this kind of multi-time frame analysis and conflicting time frames and all this fun stuff. But yeah, this is a sick product. We're really proud of it. We think it's really good value, so we'd love for you to at least check out the website. If not, well, clearly I've got no bloody issue continuing to make these videos. And if you have any ideas, feedback, comments, whatever, please leave them in the description. And it really helps me a lot and takes none of your time if you just leave a quick like and comment on this video. But especially the like side of things really helps. It's actually the number one thing I look at if I'm feeling like making a video. Good likes, good engagement, higher chance that I come out with some more content. So I'd love to see some support on this, especially given how long it's been. Right, thank you for your audience. Check out technicalroundup.com, and I will see you for the next live stream or lesson. Bye-bye.